Hi, Sajjid. Welcome to the show. It's such a pleasure to have you here.
It's great to be here, Shruti. Thank you.
So, we're recording in the last week of May, where the world is a little bit crazy. So, the world economy is turbulent. The Indian economy's got a lot of challenges that it hasn't faced in many years, maybe even in decades. The current crisis is that the rupee is well above 95 to the dollar or well below 95 to the dollar, depending on how we say this. Fuel prices are rising and will only rise further because we're almost at the end of our sort of inventory and stockpile. The import bill is rising again, same because of the West Asian crisis. And in a more macro sense, FDI has nearly stalled in India over a longer term, maybe like a decade-long trend now. Private capital investment has been not picking up, same with domestic demand. And things look like they're only going to get worse because of the global uncertainty and also, the increase in input costs. So I don't think it's a 1991 style balance of payments crisis, but that phrase is getting invoked in every other newspaper business column right now. But before we catastrophize over where we are and where things are going, I just wanted to get a sense from you on how you view the Indian economy right now in the last week of May. And you're my go to expert whenever I think about how to take stock of the Indian economy. So maybe we'll start with that and then we can go into other things.
Thank you, Shruti. Thanks very much for that. As you rightly point out, these are unprecedented times in some levels because people talk about this being the largest energy shock ever. And I think, at last count, about 14 million barrels were off stream. That's almost 15% of global energy supply. It's not just crude, as we've discussed. It's crude, it's fertilizers, it's helium, of all of that. And I think what's different about this episode is in the past, when there've been oil shocks, there was never a concern about availability or shortages. It was a question of price. And as an importer, there was a terms of trade shock, and we know what the familiar playbook is. What makes this more, pernicious is you also worry that if the strait doesn't open soon, there'll be shortages, which then invoke non-linearities. But I think let's step back and ask ourselves where the economy was heading into this event. And I think maybe we'll break this down into growth, inflation, and the external sector, if that's okay.
Yeah.
And for growth, I think let's just step back and paint a bigger picture that, India kind of entered COVID on a bit of a weak wicket because if you remember, growth was already slowing precipitously in 2019, below 4%. Then you had the growth shock, and that kind of was the trough. Then you got new growth drivers that were emerging in the pandemic.
Yeah.
So the first was, clean balance sheets. We had last seen those things back in 2011, 2012, right? For a whole decade, we were grappling with the twin balance sheet problem. Well, to policymakers' credit, they stuck at it. We first recognized those non-performing assets. Then we had a way to resolve them through the bankruptcy code. Then we recapitalized public sector banks.
Yeah.
So 10 years later, as we were in the pandemic, the good news was bank balance sheets were clean again. Net NPAs were the lowest since 2011. And corporate balance sheets were also healthy. Leverage was very low. Profits were picking up. Cash levels were high. So the good news is that you had these new growth drivers emerging. I'll talk about four of them. The first was twin balance sheets had been cleaned up and credit growth was picking up. The second was a big public investment push by the government. Again, this was a strategic choice made to say we're going to focus on infrastructure rather than cash transfers like some other economies had. And to the government's credit, it defied some of the skepticism, both on state capacity as well as fiscal space. We've seen all together, central, state, PSU, public investment pick up by about 1% of GDP. We can talk more about that. The third was this huge pickup in service exports, right? The focus was so much in 2020 about China plus one and will India benefit from manufacturing? But the real revelation was it was all on the service export side with the advent of global capability centers. And the fourth, less appreciated one was the real estate cycle had finally begun to pick up. So for 10 years, real estate was dormant. Then demand begins to pick up. Real rates are negative in the pandemic for the first couple of years. And what you see is demand picks up, inventories come down, new construction picks up. So the good news was, after the pressure points of 2019 and 2020, some of the healing began in 21, 22 as these four relatively new growth drivers came together. Now, the hope was that this would finally crowd in gross fixed capital formation or private investment. This is something we've been waiting for Godot, right, for the last 12, 15 years. But that did not happen. And we can talk about what the headwinds there are. So you enter 2024, you end 2024, where you still haven't seen private investment pick up, and we should talk about what the reasons for that are. And it was then clear that some of the pace at which public investment was moving was not sustainable. You could not have public investment grow 20%, 30% a year, both because fiscal constraints began to develop, public debt had moved up post pandemic, both the numerator and the denominator were responsible, and absorptive capacity constraints were kicking in at some point in time. So here, come the end of 24, there's a recognition that public investment will have to slow to more normal levels, grow at 8 to 10% a year, and we had not seen private investment pick up. Maybe we'll address that right up front. Why is private capex not picked up? In my mind, I don't think there's much of a mystery here, Shruti. We are kind of conditioned to thinking of the Indian economy as being a supply constrained economy, right? In the 80s and 90s and 2000s, infrastructure was a supply, bank lending capacity was a supply, and credit became a binding constraint for MSMEs. Agricultural production was a supply. But I would argue that in the last 15 years, we've worked to alleviate some of these supply constraints. Instead, the binding constraint has become a demand constraint. And so if you think about private investment, what you will notice is capacity utilization for manufacturing has averaged about 74 or 75% since 2012. Now, if you're in a world in which you've got a lot of Chinese excess capacity, which is the new phenomena post COVID, and China is exporting that excess capacity around the world to emerging markets, to Asia, to India. India's imports from China almost 4% of GDP, the trade deficits balloon. Then you can understand why Indian entrepreneurs will be risk averse, because your existing utilization rates have not moved up to critical thresholds. You're struggling to compete with cheap Chinese imports. And then you throw in the fact that we've had so many shocks: a COVID shock in 20, a Russia Ukraine shock in 22, a tariff shock in 25 under President Trump, and now you've got an oil shock. So, my short point is that what we found at the end of 2024, I was not particularly surprised, is that gross fixed capital formation had not picked up, because while there were some drivers of demand, these were not all firing in unison. So central capex was moving, but state capex was patchy. Urban consumption was strong, rural consumption was uneven. Goods service exports were strong, goods exports had lagged. So then we enter 25, and I think what the government does is one final push to say they had by then recognized that demand is the constraint. So there was one final cyclical push. You had direct tax cuts in the budget in February, GST cuts in September, the RBI cut interest rates by 150 basis points. There was regulatory easing to act as a force multiplier. We had just 2% inflation last fiscal year, so purchasing power picked up, and you had a strong monsoon. And the hope was that all these cyclical factors together, these six factors, would kind of be the straw that broke the camel's back. Now, as luck would have it, you began to see some pickup in consumption in November, December, January, February, post GST. The auto sector was doing particularly well. Come end of February, the IEEPA tariffs were reversed by the Supreme Court. India goes from having the highest tariff rate in the world to having a rate closer to 10% like everybody else. And just when you thought that maybe this is the year in which all of this comes together and there's enough demand visibility for private capex to occur, you get this large terms of trade shock from the Middle East. So I think from a growth perspective, Shruti, that's where we are. New drivers have emerged post-pandemic, but the heavy lifting has been done by public investment. And the fact is, private investment is still awaiting sustained demand visibility to invest. I'll end with one final point. I hate to invoke equations, but you think of GDP as being consumption plus investment plus government spending plus exports. C plus I plus G plus X minus M. And in I, we will just keep it private investment. In G, we lump both government spending and government investment. G has done the heavy lifting.
Yeah.
For fiscal reasons that we'll discuss, G has to step back. You want I to fire, I being private investment, which is endogenous. I needs C to pick up and or X to pick up. And so you need both these drivers to be firing to crowd in private investment. So I think from a growth perspective, that's where we are at the moment.
So, I'll also zero in on the reasons for aggregate demand not picking up, especially on the state side. So, if we think about how the Indian government is fiscally constrained, right? Because you were talking about how the G needs to get smaller. So, India's public debt to GDP is about 75%, which is
Actually 85 now. So
85 now.
Yes, 5, yes,
Okay,
yes.
so I'm already a little bit behind. The center plus state deficit is above, between 7 to 8% now. We have almost 60% of the state government expenditures going towards payrolls, pensions, and welfare transfers. And welfare transfers have really ballooned in some sense, right? This is the post-Geo, post-Aadhaar, post-Jandhan account transfer, so kind of a frictionless transfer system and just never-ending election cycles. Now, this has two kinds of impacts in different directions. So one is these transfers should have boosted demand, right? And that was part of the reason, other than trying to win elections and support different interest groups, to actually have these transfers. Now, that hasn't quite shown up in the numbers, at least not consistently. But the other side of it is it crowds out state government level capex. And that obviously has an impact on private capex in those states because, all capex gets crowded out because of this. So far, given the trend, it seems like that seems to be the dominant sort of like the pull factor in pulling us away from capital expenditures in a way that even welfare transfers are not able to boost aggregate demand to encourage private capex. Is that a good way of thinking about it, or are there other things going on at the state level?
No, that's a great starting point, Shruti. So I think first, some of this should not be a surprise because if you think about a lot of work that's been done, theoretical work on fiscal multipliers, right? It's no doubt that in the medium term and long term, capex multipliers are much larger than transfer payments, right? So we should not be. It's not a good trade-off to be cutting public investment for short-term demand stimulus by giving more cash transfers. And we're finding that out. B, remember what's happened in the state level is also that deficits have widened. So this is not just a compositional issue where, of course, there's a compositional issue here where there's more cash transfers you do, there's less space for public investment, health, education, but fiscal deficits have widened. So states used to be around 2.5, 2.6% of GDP. They're now at 3.3% of GDP. And what that does is that this higher borrowing by the states has meant that bond yields have moved up, spreads of state moved up, which then affects the whole panoply of interest rates in the system. So that too at the margin has an impact on private investment decisions. I think on the aggregate demand question, I come back to kind of first principles, and that is that all of this can temporarily help. So we saw between 2013 and 2019, consumer leverage went up a lot. This was the advent of the NBFCs, the non-bank finance companies. And so India households had low leverage and they kind of levered up, right? Then you had interest rate cuts last year. You had welfare payments. All of this helps with the margin. But it ultimately comes down to household income prospects, which come down to quality of employment, right? And there, policymakers have tried a lot, but the fact is, what we've seen is that the quality of employment, we haven't had the kind of dramatic structural transformation that we had hoped for. And I think this is not true just of India. We've seen in other emerging markets that COVID, reversed some of the structural transformation. Too many people were still in agriculture and had, not enough in goods and services. So for me, that's the key to long-term consumption. Everything else is a short-term fix.
Yeah.
That when we get quality of employment, labor productivity, wages right, then consumption will be strong and sustained, because households are going to say other things may well be a short hit, and so you smooth over that. If it's a temporary support, you sometimes smooth. You have to go back to having a permanent income shock to be able to lift consumption more sustainable.
Yeah. So, what you just said, I've also seen that as an arc in your longer term writing, let's say over the last decade. So, I've been reading your columns. Like I said, you're the go to person for all of us to understand what's happening in India, especially, in the external sector and economic growth. So, one way to read your work from, say, 2016 to 2019, 2020 was your arguments about how India's first order task was to institutionalize macro stability, avoid a lot of stimulus, especially premature stimulus outside of the COVID years, and protect, have policy certainty, right? And also policy credibility in terms of having a very clear pathway towards reforms like for GST and bankruptcy law and MPC and so on. And now, when I read your work over, say, the last 2 to 3 years, it seems like your to-do list has changed, right? So now the first order task is employment, consumption, FDI, exports, and private capex. Maybe exactly in that order, the way I've been reading you. So what has changed in your diagnosis? Is it that the binding constraints have changed? Is it that we've just solved the old macro stability problems? Those are just not big problems anymore. And, inflation's been relatively low, even with relatively high rates of growth. We're just not in that situation we were in 30 years ago when we did the first stage of reforms. So now, there just has to be a complete change in priorities, both because the global environment has changed, but also what are the binding constraints domestically?
It's a great question, Shruti. I think you nailed it. It is the binding constraints. We don't even have to go 30 years ago. We just have to go 13 years ago
Yeah.
to 2013,
Yeah.
because we had this period, between 2010 and 2013, post global financial crisis, where growth was very strong.
Yeah.
Those times growth was 9%, 10%, but it was unsustainably strong because it was happening where very large fiscal stimulus, real rates were negative. It was spilling over into a large current account, and some of us were worried that at some point this would unravel. And that's what happened in the taper tantrum. So the morning after the taper tantrum, I think some of us were more concerned to say that we need to recognize as a country that macroeconomic stability is the foundation for sustained growth, that there is no trade off, either in the near term or in the medium term for sure. And I think policymakers credit right from 2013, right from the year of the taper tantrum over the last 13 years, what's been very encouraging to see is an institutionalization of macroeconomic stability. It started with the inflation targeting framework. I was fortunate to be on the
You were
committee.
part of a lot of these institutional changes yourself, so you should take some of the credit.
Oh, no, no credit, but it was just very nice to see that this happened very quickly.
Yeah.
So I remember, the taper tantrum happens from June to August.
Yeah.
By September, a committee is set up, and I was lucky to be on that, which is to think of a new monetary policy framework.
Yeah.
By January, our report is out arguing that India needs a nominal anchor. We need to go from WPI inflation to CPI inflation. We need to have a target and a band. We need to have a monetary policy committee. And de facto, that gets implemented a month later in 2014, February. And then the government notifies it the next year. And here we are, 13 years later. Most people, or almost everybody's going to say this has been an unambiguous success. And I think when I talk about institutionalization, what I mean is, think of what happened the last couple of months. An oil price shock occurs. We're just in the early stages of that. And already commentators are saying, oh my God, inflation is going to go towards 6%. Will the RBI be raising rates?
Yes.
Now, whether the RBI raises rates or doesn't is less important.
Yeah.
What is really heartening is that the framework is immediate recall to everybody.
Yeah.
So it's been embedded in everybody that the central bank is serious about inflation targeting. There's a band here, and I think all the governors over the last 14, 15 years have reinforced that. Similarly, in fiscal policy, that fiscal policy from 2016, again, the NK Singh committee report on debt management, that we now have an anchor for debt. There have been lots of shocks in between, but we now all recognize, we talk in those terms, that public debt is 85%.
Yeah.
And, post pandemic, I don't think any level of debt is sacrosanct.
Yeah.
What matters more is debt dynamics.
Yes.
That as long as debt is not on this inexorable increasing path, you can stabilize debt first and bring it down. We're okay. And so the fact that we have this framework on debt, the center has said we want to bring central debt down. There are a lot of questions about state debt that we should get into. So these are all extremely encouraging signs for me. And we've begun to see the fruits of this.
Yeah.
Inflation has been low and contained. Inflation expectations are far more anchored. One would argue risk premia on government bonds has fallen over the last decade after this. So the reason that other priorities have emerged is because this is we're a victim of our own success.
Yeah.
That we prioritized macro stability, and then we've had a series of shocks. COVID was not any small shock.
Yeah.
And so I think the employment imperative has just become more urgent because we fixed the macro stability problem, and we've realized that there's one other thing, Shruti. Sorry, I'm digressing. The- you know, underneath all of this has been the fact that manufacturing and now services is getting so automated.
Yeah.
If you look at India's capital labor ratio, you look at the annual survey of
It's
industry,
bananas for a country that is so
bananas from
labor
2000.
rich.
Exactly. So from 2005, there's this very sharp increase in capital labor ratios, which is to say that for every unit of output, we're using more machines and fewer people. Look at our export basket. It's all pharmaceuticals, engineering goods, capital goods, and the labor intensive stuff, textiles, leather, gems, and jewelry have reduced in share. So I think it's a combination of all this. We've solved the macro stability problem. The employment problem is coming to the fore because of capital intensity around the world, because COVID has done damage to all emerging markets. And now it's become a binding constraint. It's not a nice to have. Only when we get strong and sustained employment will we get the consumption that will drive the private investment. So it's become a binding constraint.
So, I don't know if some of these reforms would come under micro level reforms or macro level reforms. So, for instance, say fertilizer subsidy, right? The fuel subsidy and energy subsidy that we give, like free water, free electricity to farmers. So, these don't sound like macro stability issues, but when we add it all up, like all your agricultural subsidies, it's like 2% of GDP. It's crazy how large that number is. But the second part of it is also it distorts prices in a way that kind of ricochet through the rest of the economy because these are all factor markets or very, very crucial inputs to pretty much everything else. So, is there a reason that this kind of reconfiguring government spending, which I would think is still a very macro, big picture question, has just not come within the macro spending priorities? Or is it just so politically difficult that, the technocrats have tinkered with whatever they can tinker and said, okay, we can do inflation targeting in a small committee. We can't do anything about this. So we'll just do the inflation targeting in a small committee. So what is a good way to think about that?
That's a great question. So I think there's so many elements to what you've asked. One is just how we think about fiscal policy more generally at the macro level.
Yeah.
And I think the first order was just to take large deficits and ballooning deficits and bring them to a level where debt will stabilize. And that was the first kind of task which we are on right now. Then you get to the more important task that I think we have to re-examine the entire fiscal architecture. First and foremost, I think we have to and I'm going to answer your question in particular. We have to get to a situation where you know this is a new world which is becoming increasingly shock prone. First, get our heads around that. The old world is gone, right? And now, just in the last 6 years, you've had a pandemic, you've had two wars, right? You've had an AI issue. So, how do we become a more shock absorbent economy? And central to that is always retaining fiscal space to be able to buffer some of these shocks. That is going to mean on the revenue side, we have to raise more resources because the only way to meet our expenditure priorities and bring debt down, the only way to square that circle is to raise more revenue. So that's a whole different debate to have. Should this be, we don't want to do this in a regressive manner. So we don't want indirect taxes to do the heavy lifting. We want direct taxes. That's a question we've been asking for many decades.
Which means we need a broader base.
In a much broader base, number one. And we also have to think strategically on non-tax revenues.
Yeah.
There are lots of government assets that we own. Is there a way to monetize those assets smartly over time to raise revenues? So I think of the revenue side as creating the resources that then give you fiscal space to handle shocks.
Yeah.
Expenditure side has to do with the reallocation of expenditures, as you pointed out, because in this new world we also have to be very cognizant that human capital augmentation is so critical that we need more resources going towards health spending. They may not be a sufficient condition, they're a necessary condition.
Yeah.
Quality also matters, but we need more money on health, on education, on the green transition, on creating smarter safety nets. And that is going to mean that you have to redirect resources. Now, Shruti, my guess is the same as yours, that some expenditures from a political economy perspective are easier to reallocate than others are. But yes, at some point, we have to look at these subsidies from two perspectives. One is how much fiscal space do they open up? And even if it's fiscally neutral, can we replace a product subsidy with a cash transfer? Because the former distorts product markets, right? And the latter doesn't. So these are difficult questions, but ones we'll have to eventually confront.
But here I want to push a little bit more to unpack the link between the quality of the welfare transfer or the government spending and the macro stability questions. So, there are two ways to interpret what has happened. So, one is, of course, we're so happy that we've managed to get some kind of guidelines for deficits, for inflation targeting, now for debt, and so on. But that means that there is a limit on how much government can spend, and one would have hoped that the first lot of spending goes towards the highest multipliers, which is capex and then health and human capital and education. But that has not been the case. So now what we have is we are within the limits, but that has distorted the quality of spending. Because with earlier governments, maybe even say 15, 17 years ago, they were just spending too much, but then they were spending on all sides of the welfare state, so to speak, right? They were giving the subsidies, but they were also investing in capital expenditure. They were also investing in social safety nets through Narega and so on. Now we have every interest group, as Devesh Kapoor and Arvind Subramanian have said, suckling at the Indian states, right? So we have every interest group doing that, but you have a lid on it. Yes. Which means they never quite get to the good expenditure. So are these two things just a lot more linked than the policy wonks are giving credit to?
No, they're absolutely linked, because there is no free lunch anymore. Now, fiscal spending has become a zero-sum game, precisely for the reasons you mentioned. Now, there's one way to break that cycle, right? And the way to break it is more revenues. So if you can do more on tax to GDP, on non-tax to GDP, then you can spend more on everything without changing your fiscal deficit and therefore your debt dynamics.
Yeah.
Right? Therefore, I'm saying these things they're inextricably linked.
Yeah.
So if you do a better job on revenue mobilization, there's more for everything.
Yeah.
But holding that constant, right? Then the expenditure side becomes a zero-sum game.
Yeah.
And if you want to spend more on education and health, as we must, then it has to come from somewhere. And I'll make one more point, that at the central level, what's happened is encouragingly, public investment has picked up a lot. But what you're seeing is non-interest revenue expenditures are down to levels that we haven't seen before.
Yeah.
So there's not much more flab to cut on the bone, right? And therefore, if you need to do more spending on the green transition and health and education, hard decisions on subsidies will eventually have to confront us.
Yeah.
On the state level, what's been worrying is, electronic cash transfers. Now the transaction costs have gone away. You press a button and people get cash in 24 hours and 48 hours. Right? And then you get into a competitive populism, because if state A did X, then it's incumbent on state B to do X plus delta, and the delta is often quite large.
Yeah.
So we need to evolve a national consensus on this.
Yeah.
Because I think, there's a time inconsistency problem from a political perspective. The cash transfers happen today, the election is tomorrow. But the foregone impact of that on health, on education, on public investment at the state levels, it shows up 5, 10, 15 years later, right? So I think there is a real urgency that needs to be addressed at the state level. The other last thing I'll say is the fact that state deficits have widened so much
Yeah.
has partially undermined the center's consolidation. So, despite central consolidation, the fact is the combined deficit this year is upwards of 7%. Now, in
Yeah.
peacetime, you
Yeah.
can't be having a deficit above 7%. What happens when there's another shock like we're experiencing right now?
Yeah. No, so, on eh, the last part on this, so one of the other crazy bits that we spend on is something like MSPs, right? Suddenly, we might be walking into a big supply side shock, rising fuel prices and therefore rising inflation. Now, MSP also contributes towards that, right? So, what is a good way to think about some of these input subsidies that are meant to keep prices high? They hurt you both on the government spending side and the quality of the government spending, but they're also going to hurt you now very soon on how we think about food grain prices, given that there is all this other rampant inflation coming our way.
That's right. In fact, in a paper we did, Shruti, I think it was Prachi and me back in 2015
Yeah.
on what is responsible for India's sharp disinflation.
Yeah.
That was time in which there was a new monetary policy framework, but we also had lower food prices. What did we find? That MSPs were actually key on two fronts, not only for contributing to inflation, but there was an embedded persistence in inflation that MSPs caused,
Yeah.
right? Because when inflation was high, the inputs into MSP determination, were meant that inflation became more persistent. So, for all of these reasons, but these are easy for me to say from a political economy perspective, much more challenging to do. But in a perfect world, you want to move everything to cash transfers, right? Like you want to be providing support, but you don't want to be distorting prices, misallocating resources, and then creating this import dependence. I mean,
Yeah.
fertilizers are a huge import.
Yeah.
The Strait of Hormuz makes us more vulnerable.
Yeah.
So my sense is that, yeah, these are not easy questions to address. The good news I will say is that we've been very restrained on MSP increases for the most part the
Except
last
recently.
5, except recently.
Yeah.
But I think, and this is not unrelated to the inflation target,
Yeah.
because when the central bank makes a public commitment to inflation, then there is it's incentive compatible for the fiscal authority to play along, recognizing that if MSPs were to be extraordinarily high and that pushes inflation up, then the RBI would have to offset that by tighter monetary policy. But you're right. I mean, holding that apart, tough decisions on subsidies await the fiscal. But I would say it's not just subsidies. We need to rethink the entire fiscal architecture. What level of debt do we want to reach? What burden sharing will happen between the center and the state? Remember, central debt is coming down.
Yeah.
State debt is
Debt
being
is going up.
rising
Yeah.
on a monotonic path, right? So if you're going to allocate, if you're going to have an overall public debt target, uh, who has to do the heavy lifting, center or states? That's not an easy federal question to answer. And then the question about what are our new spending priorities? Where will that fiscal space come from? There's a whole architecture here, question on fiscal, I think, that extends beyond just subsidies.
Yeah. The reason I wanted to zero in specifically on fertilizer, MSP, and so on, it feels like this is that crisis that maybe we should make use of because the fertilizer bill is just shooting up. Is this the time to kill the fertilizer subsidy? And the war has given us a great opportunity and yet another, not balance of payments crisis, but balance of payments problem.
External events open up political space. It is the best time to do it from an economist perspective. Of course, politicians may have a different view. And we saw this in 2022. In 22 as well, the fertilizer subsidy balloon. And this, and in a way, Shruti, this is going to, the trade-offs that we spoke about will be in full display in the coming year. Because if the fertilizer subsidy bill is higher, then you've got uncomfortable trade-offs between, do you want the fiscal deficit to widen beyond what you had budgeted, which then has implications for debt dynamics, interest rates, reputational costs? Or do you keep the fiscal deficit within target, but then you make hard decisions about cutting public investment? So both those trade-offs will come to the fore, in a year like this.
Yeah. And especially now with the rupee depreciating, right, our import bill is going up. So both on fertilizer and fuel, we're going to feel the pinch very, very soon. I mean, we're already feeling the pinch, but it's only going to get worse depending on how long this continues. Now, this is a multi-part question, but just to start with, you have been a very vocal sort of supporter of letting the rupee depreciate and find the appropriate level for various reasons, which we can get into in a minute. I mean, you held this view right now in your column like a few days ago. You held this view in November last year with all the Trump tariffs piling on. You held this view, in 2019. Uh, so, what is it about the Indian establishment that has this obsession with a strong rupee? Is that just an optics thing? Is it maybe like a very self-serving thing that the people who are like IAS officers have to pay college fees in dollars and want the rupee to be stronger? Like, what exactly is going on with the Indian establishment that this is not about global prices and thinking about export competitiveness?
Thank you, Shruti. I think first and foremost, I'm very happy that in the last 15 months, 16 months, 18 months, we've let the rupee depreciate, right?
Yeah.
We have depreciated almost 14 or 15% in real effective exchange rate terms. So I'm glad that that Rubicon has been crossed. Now, it's not just the establishment. There's skepticism among market commentators, the private sector, industrialists, and there's a belief that, oh, we're an importing country. So when the rupee depreciates, our imports become more expensive in rupee terms. This is going to be inflationary. And there's an overriding skepticism about exchange rate elasticities.
Yeah.
That, oh, if the exchange rate were to depreciate, you're getting inflation, but you're not going to do much on exports and imports, And so the burden of proof is on us. And again, paper that I wrote for the IPF in 2018,
Yeah.
RBI has done some similar work, clearly shows that when you control for these things carefully, the real effective exchange rate clearly has an impact, holding other things constant, clearly has an impact over time on export competitiveness. What you see sooner, and the part that's less appreciated, is the import part.
Yeah.
Right? So, on the one hand, we're complaining that Chinese imports are flooding India.
Yeah.
And then until the beginning of this year, the real effective exchange rate vis-a-vis China, India versus China in bilateral terms, had strengthened by 10%. That's a fancy way of saying, in real terms, Chinese imports at the beginning of 26, before the recent depreciation, were 10% cheaper than they were 5 years ago, right? So we had China already has this advantage in terms of cost, and we give them another 10% cost. So I think it's incumbent upon some of us. There is skepticism across the board to prove that, And remember, I keep saying the rupee is like a shock absorber in the following sense. When you're driving a car, think of the rupee as being your seatbelt.
Yeah.
Right? When you brake suddenly, something has to take the
Has to
shock.
give, yeah.
It's not the seatbelt you are. The variables we should care about are employment,
Yeah.
growth, inflation.
Yeah.
The rupee is just an enabling mechanism.
Yeah.
Rupee by itself should not be attracting so much attention, right? If it absorbs the shock, other domestic variables that matter to us don't have to move as much. But I'm glad to see that in the latest episode, that thinking is taken over. I will say one quick caveat to my own thinking, one needs to be careful about speed
Yeah.
and nation.
Yeah, it shouldn't spiral such that then, foreign inflows start rethinking their
That's
India strategy and things like that, right?
I think that's the balance you have to get right, because what you see in the latest episode, in fact, in my last column, I was saying we definitely want the rupee to depreciate.
Yeah.
But if you put too much burden
Yeah.
on the rupee being the only adjustment mechanism for the balance of payments,
Yeah.
then you risk such a rapid depreciation that this becomes self-fulfilling. Already you've begun to see the last few weeks that importers, corporates, foreigners have begun to hedge their stock of FDI, stock of ECB, stock of FPI. And once you go down that path, then you get into a self-fulfilling loop, because you hedge your stock. That puts more pressure on the rupee. The more the rupee weakens, the more the desire to hedge. And we want to break that cycle. So we want rupee depreciation, but not too rapidly so as to, unanchor expectations in the rupee market.
Yeah. No, I mean, that makes perfect sense. But, when I was reading all your columns now again to prepare for this conversation, all the more recent columns where you're calling for, a rethinking rupee depreciation and doing it slowly and in stages, it reminded me one of your older papers with Toshi Jain on the Dutch disease. So the Dutch disease, for those who are unfamiliar, comes from this sort of like windfall that the Netherlands got in the 60s because they discovered more natural gas and energy resources and so on. But what happened immediately was that there was this big inflow of foreign exchange, which made the guilder those years before they had moved to the unified currency stronger, and it made Dutch manufacturing less competitive. So basically, one booming sector effectively sort of strangled their other competitive sectors, right? Now, that's not exactly the argument, but you make a pretty elegant argument in this paper where you talk about the fall in oil prices and therefore the import bill being the big windfall gain equivalent, for India. And that led to the rupee appreciating in real terms, which also coincided with a decrease in its export competitiveness. So, what is a good way to think about that given the situation we're in right now? So, right now we're seeing the exact reverse of what happened in your paper, right? You're seeing the import bill rise, you're seeing the rupee depreciate. Now, which factor is going to have more impact, right? Are we going to become more competitive in our exports because the rupee has depreciated close to 15%? Or is it going to be harder because the fuel bill is going up and the overall cost of production is going to go up and it's going to weaken our export competitiveness?
No, I think there's no doubt that, that this is all controlled for when you measure these things, that as long as there's some domestic value content, your exports become more competitive, right?
Yeah.
Even if the import content is 70%, yes, that 70% moves in line with the exchange rate. But on the export side, the full 100% is moving in line with the exchange rate. So the larger the domestic value content, the greater the competitive advantage on exports from a weaker rupee. And those are the estimates that we found out to be fair. These things have attenuated over time and show that, but it's still economically and statistically significant. We found that for the exchange rate, the RBI's found it. So, Shruti, a weaker real effective exchange rate over time will help not just export competitiveness, but make imports more expensive and therefore help domestic substitutes on the import front. We tend to ignore that part.
Yeah.
Now,
So on that, the elasticities that you find were not very reassuring in terms of sort of spurring domestic supply chains, right?
Yes. No, that's on the import front.
On the import front. So what is a good way to think about that?
Yeah. So I think, again, different studies find different estimates. Some other studies find the opposite of what we found, that they found the import elasticity is larger than the export elasticity.
Oh, wow. Okay.
Exactly. And that moves faster because imported goods, get more expensive immediately. Right. And then to the extent that there are domestic substitutes, those tend to expand. Right.
Okay.
So there are different ways in which this happens, but I think it's fair to say prices matter. And right. And in India, studies that look at this carefully find that when you do get exchange rate depreciation, that compresses the current account. Now, the larger point about we need to also think a little bit more first principles. The equilibrium unobserved real effective exchange rate, right, is a function of many things. When you get a positive terms of trade shock through lower oil prices, your equilibrium rate itself should rise, right? When capital flows increase, for example, your equilibrium rate should rise. So part of this is to understand where is the real effective exchange rate vis-a-vis its equilibrium. And one of the reasons that I think we should let the rupee weaken is because, by all accounts, with FDI slowing in the last 3 years and India experiencing a large negative terms of trade shock, both of these would argue for a much weaker real effective exchange rate. So those that say, oh, the RBI's index was 100 3 years ago and now it's 92, means the rupee is undervalued by 8%, are presuming some static real effective exchange rate. This is a dynamic concept that changes when exogenous shocks happen. And I would argue India's equilibrium rate is much weaker, and we are facilitating that adjustment towards the new equilibrium.
Yeah. So, you talked about FDI, and also this is your most recent JP Morgan report, along with your co authors, has talked a lot about the capital flows, right? So, capital flows have shrunk, you point out, from 2.6% of GDP between 2015 and 19 to about 1.4% in 2024 to virtually nothing in last year in 2025. So, another finding that you have in the paper, which is related to this, is that in the last 15 years, net FDI to India is inversely correlated and very strongly so with US Treasury yields, right? So, one, FDI has been slowing down. Two, a lot of it is outside of our control. But there are things which are within our control, which also are things that you talk about, because Vietnam has not had a similar plummeting of FDI, right? They've done pretty well despite the same global situation. So, what is a good way to think about the factors that India needs to focus on the very short run and the slightly longer run, on how to bring in FDI inflows with the rupee where it is?
That's a great question. I think the way to think about FDI is that FDI flows because there are both push factors and pull factors.
Yeah.
The push factors are global.
Yeah.
When global interest rates went to zero in the pandemic,
Yeah.
money flowed to all emerging markets, right? But then you lose control of your own destiny, because when global factors change, FDI can dry up, like we've seen the last 3 years. What's more important is to focus on pull factors, right? That what is it that a country can do to come across being attractive, and FDI gravitates towards that. And what we show in the paper is that there's one clear episode where India has strong pull factor. It's between 2005 and 2010. What happened then? You had this big private investment cycle, right? A big private investment cycle. And so the quantum of FDI that we attracted could not be explained by where US rates were. And that was India's pull FDI.
Yeah.
After 2010, Shruti, as you pointed out, it's been more push FDI. And it should be no surprise, because we've just discussed earlier, we haven't seen private investment pick up.
Yeah.
Right now, Vietnam, in contrast, all appears to be pull FDI, because Vietnam's FDI has been almost flat as a pancake at 4.5% of GDP and invariant to global financial conditions. So
Yeah.
I think the lesson is very clear. What do we do to make India a more attractive destination? It all boils down to starting a fixed investment cycle. My impression is always FDI is complementary to domestic investment. When domestic private investment starts, it tends to catalyze FDI. So I think that's the short way of doing that. Now, this matters because, in the past, we always talk about India's sustainable current account deficit being 2.5% of GDP.
Yeah.
But that, in a way, was because we were attracting 2.5% of capital flows.
Yeah.
If your capital flows reduces,
Yeah.
then your sustainable current account deficit reduces, right? And that then has implications on what your investment rate will have to be, because ultimately, the current account is nothing but the investment minus savings rate.
Yeah.
And as an emerging market at our level of per capita income, we don't want a current account which is 0.5% of GDP. We want a current account which is 2.5% of GDP, because that's telling us that investment rates will be higher and potential growth is higher. It's like blood pressure. You don't want blood pressure to be too high,
You don't
but
want it to
blood
be too
pressure
low.
that's too low is equally worrisome. I
And
think
right
that's
now, our current account deficit is too low, right?
it is too low. It's been 0.5% of GDP the last year and 0.8% of GDP the last 3 years. And that's another sign about investment, because if you think of the current account as being investment savings gap,
Yeah.
that is the sum of the public investment savings gap, which is the fiscal deficit,
Yeah.
and private investment surplus, savings minus investment. So with a combined deficit of above 7% of GDP,
Yeah.
your current account is only 0.5% of GDP. It's telling you that private corporates have too much saving and are investing much too little. So all of this, whichever way you cut it, comes back to what do you need to do to boost private investment?
Yeah. Yeah. So, I have a couple of different questions on FDI, but I'll start with press note 3, right? Which happened, for multiple reasons, pandemic, Galvan. And this is, uh, it didn't start out as a anti-China FDI policy, but it effectively became one. It was all Indian bordering states. And it wasn't saying no to FDI from bordering states or neighboring states. It was that we'll look at it and you need a permit, like the good old, license permit Raj world. So we kind of did with FDI what we've done with quality control orders or what we did in the 1980s with the rest of the economy. And so do you think this plummeting has in large part been because of this? Because the one country that does have the ability to invest in India in fairly large proportions is China. And we kind of shot ourselves in the foot with Press Note 3, which we've now amended. And you've been talking for many months about relaxing the constraint on China and actually inviting more Chinese FDI. But is that the reason that things went so bad so quickly for FDI?
I don't think so, actually. Now, prospectively, opening up investment to China will help, and I'm argued for that for different reasons, for risk management reasons,
Yeah.
because I think China now is looking for outbound FDI, and you see this all across Asia. But I don't think it's the primary reason, Shruti, because if that was the case, then you would see that in 2019, FDI would have gapped down.
Yeah.
Instead, right, because this happened in 2020.
Yeah,
Instead, the
2020.
opposite happened.
Yeah.
FDI gapped up in
Yeah, but that's
2020.
because of the US yields just dropped, right? Yeah.
My sense is at the margin, every bit helps. So I think
Yeah.
prospectively, and the reason I'm saying this is because it's not just FDI. Yes, we want more FDI, but it is for risk management. I think one of the things we've realized in this last 6 months is, quite apart from energy dependence, it is choke point vulnerability, right? And it's well understood that now, a lot of our LPG comes from the state of Hormuz, a lot of our gas comes from Qatar, and we need to diversify that. But we should be cognizant of the vulnerabilities we have with China, right? 70% of our APIs come from China.
Yeah.
And by some estimates, for antibiotics, it's 90%.
90%, yeah.
Polysilicon, which is used for solar panels, almost all of it comes from China.
Yeah.
Lithium ion batteries, all of it comes from China. So my argument is that allowing Chinese FDI does two things. A, it helps you with FDI as a source
Yeah.
of capital opposed to finance a current account. But B, you take away the prospect of imports being weaponized.
Yeah.
If you've got that FDI in India, and a domestic company is in a joint venture with a Chinese company, and you're getting some domestic capability, production capabilities, value is being created onshore,
Yeah.
jobs are being created onshore, you become less vulnerable to those imports suddenly being shot down. So I think for all of these reasons, we need to think carefully and try and get more Chinese FDI into India.
Yeah. So, you've been talking about how the pressure, the more recent pressure, which is so weird for those of us who've been looking at this over the last few decades, right, is capital account led. And net FDI has dried up because of high yields, all the other pull factors not working out, as you talked about. But can you think about a similar push and pull framework when it comes to foreign institutional and portfolio inflows? Some of the outflow is obviously global, which is US yields and geopolitical risk, but some of it may also be India specific, right? Which is just weak earnings across the board. There's a fair bit of regulatory uncertainty, right? SEBI changing its mind on its derivatives framework. Do we have a sense of what kind of market we wish to be for institutional investors? And are we consistent with that? Or is there just too much regime uncertainty caused such that, there's also outflows on that margin?
So I think regime uncertainty has been in India forever, right? Right, we've always had that, and we've had a situation where we've had strong portfolio flows come in even back then, right? This is there in the 10 years ago, 20 years ago, 25 years ago. I think what markets are looking for is in a world in which there are compelling pull factors now, right? So I now look at Asia, you can see what's happening in Taiwan and in Korea and in Singapore and in Malaysia. They're all intrinsic and part of the AI supply chain.
Yeah.
You look at Latin America, and equity flows are going there because they're benefiting from commodity export. So I think what we need to look at is what is the India specific pull factor. And when you talk about 1991, my sense is this is not 1991 in terms of a balance of payments problem, because the conditions are very different. But this should be a 1991 moment in jump-starting reforms. And I think sense is that the reforms of the 1990s have run their course,
Yeah.
right? Yes, we've seen some new reforms in recent years, the bankruptcy law, GST, labor laws last year. We're getting some China plus one. But I think what we need to do is what is the next set of measures that's going to improve India's structural competitiveness?
Yeah.
I want to emphasize structural competitiveness. What can we do? And this is the right moment in time, Shruti, because uh, I think of global value change as being a club with closed membership. For many years, the membership was closed.
Yeah.
Now, because of what's happened in China, China plus one, multinational companies are looking around to say, I want a hedge away from China. And the old hedge, which used to be ASEAN economies, is not deemed to be as much a hedge because after the transshipment risk under the Trump administration, getting a hedge from China means actually leaving ASEAN as well. If you go through Vietnam, there's always the risk of you being accused of transshipping goods through Vietnam and attracting high US tariffs. So this is an opportune moment because firms are looking for other destinations. And I think this is when we need to think of this as being a 1991 moment to push forward the next set of reforms on factor market reforms and on deregulation, on import tariffs, on QCOs, on an export push to say, listen, this is India's compelling pull story. I think when that happens, whether it's FTI or FII, India will get it. I mean, earnings are simply a symptom, right? When you have private investment and earnings will reflect that.
Yeah, so they all go pro-cyclically, right? If one thing picks up slowly, all of them will start picking up with the lag. And all of this has to be done at the state level. So it should technically be more doable on an experimental basis. All the reforms that you talked about. Most of
Not
these
only
structural reforms are state problems.
and not only more doable, this is where comparative federalism matters, right? And it's good to see that. That now states are actively competing with each other. And in fact, when the next dollar of investment goes to state A, there's visible disappointment and disenchantment in state B. That's healthy competition. Now, of course, so I think, as you said, reforms are more at the state level, more horizontal, but this also takes more time. I think the center will need to enable an ecosystem where this can happen rapidly.
Yeah. So, one of the areas where you have been consistent now for like 25 years, not just the last 5-10 years, is on uh, exports being the growth story, right? And on this, most of our colleagues who were on our side have changed their mind. Some of them more recently, just because the tide has turned. I mean, 5 years ago, it was about Danny Roderick and, premature deindustrialization, and that old globalized world has just ended. More recently, it's about resilience and geopolitical shocks. Now, your argument's actually very consistent that it's not going to build resilience, right? And export led growth is really the only way out and the only way to build resilience. And having industrial policy, import substitution, these things are actually eventually going to hurt your export competitiveness, which means they will hurt your growth and therefore lead to lower resilience. What is the part of the trade-off that other people are not seeing? Because the way you set it up, if I understand it correctly, is we need economic growth. That's what gets you resilience. There's a certain trade-off on how many percentage points of growth you're willing to trade off, depending on whether you're at war with China or there's some global geopolitical event. But it can't be too high and it can't hurt your export growth too much because that's what's going to lead to your economic growth overall. So what is the part of this trade-off that you and I are on one side on and everyone else is on another side, and I don't know what's going on anymore?
We're preaching to the converted over here, you and me. But let's just stipulate some facts, right?
Okay.
Because sometimes needs repetition. Uh, so if India needs to get to $15,000 per capita by 2047, which is the prime minister's laid out, I think it's a really
It's a great
aspirational
goal,
great goal. It's doable. We need to get there. What does that mean? Let's break it down. In per capita dollar growth terms, this means we have to grow at 8%, 7.9 to be exact. The last decade, we've grown at 6%, 5.9. So over the next 20 years, we've got to up our dollar capita growth rates by 2 percentage points. Right? Now, that's the ask. Only 13 economies in the world, the last
have
100
ever
years,
grown at that pace.
have grown at 7 or 8% for this length of time. They all had one thing in common: lots of global engagement, lots of exports. Why? Because the global market is just that much bigger.
Yeah.
And for all the reasons you and I have discussed in the past, exports force at certain economic scale. It forces a disciplining mechanism. Think of our whole IT sector, right?
Yeah.
Just look at the productivity growth and the Infosys and the Wipros and IT sectors. Again, because they were globally exposed, they had to be world class. India's own economic history, which is the time we had very high growth in the first decade of the millennium. People don't fully appreciate this. It was export led growth. Exports grew in real terms at 16% a year between 2003 and 2011.
Yeah.
Because exports was the driver of growth, investment, which is endogenous, responded to that.
Yeah.
Capacities expanded, and investment grew at 9.7. Consumption growth was less than 6%.
Yeah.
India's batch of burst of miracle growth happened because of exports. So I think we should first mandate that there is no example in history of 7% growth for 2 decades, which is our aspiration, which is not based on global engagement. Now, the question is, how do you get that global engagement in this economic environment? That should be the real question.
Yeah.
And I would argue that here, starting point, we've seen that even in the last 3-4 years, yes, the global environment has become, more vitiated, right? But our service exports, for example, have gone
Have
from strength
done
to strength.
really well.
Global share. So when you're globally competitive, it doesn't matter how fast the pie is growing.
Yeah.
And I think that's going to continue. On the goods front, we're still less than 2% of global market share, which is at this point an advantage, because what it means is that even if the pie is not growing, I don't need for the pie to grow. Yes, a rising tide lifts all boats. That's easy.
Yeah.
But even if the tide is not rising, if my share is only 2%,
It
and I
has
simply
nowhere to go but up.
nowhere to go but up 3% or 4%. The difference is that early export growth, when the rising tide lifts all boats, you don't have to do very much.
Yeah.
But now the importance of improving structural competitiveness is even higher, because to get that 1.7% or 2% manufacturing share to go to 4%, we have to increase market share. And increasing market share means doing better than the next guy, which means you have to become more competitive. So, and that's one part. I'll just take 2 quick points because it's a very important question. As you know, graduate school first class of trade, and Krieger, whom you and I know well. Anne's first point is an import tariff is a learner symmetry theorem. An import tariff is the same as an export tax, right? So when we think about import tariffs, we have to be very careful to understand that's as pernicious as an export tax. And worse, a non-tariff barrier on the import side is even worse because they're opaque and transparent. Now, the good news, Shruti, is it's not all gloom and doom. In the last 2 years, I sense a perceptible shift in India.
Yeah.
We're signing more free trade agreements. I think the 50% tariff last year kind of gave us a boost. We've begun to bring import tariffs down. We have much more to go on that front. We've begun to look at the stock of QCOs, quality control order. We need to do more in that front. But we need to be mindful that if you're pursuing an export-led growth, we have to rationalize the import side. The last thing I'll say is, in my mind, there is no trade-off between resilience and export-led growth. Resilience means identifying the weakest point of your supply chain. We don't have polysilicon or lithium-ion batteries or LPGs. Solve for that. Resilience doesn't mean replicating the entire supply chain at home and import substitution. We should make a big distinction between resilience, which is to say, look for the weakest link of the chain and solve for that. Either build buffers at home, diversify your imports, look for substitutes. It does not mean we have to go back to autarky and make everything ourselves. So I think that's a very important distinction. So I don't see any tension here between becoming a more resilient economy. Yes, for certain highly sensitive areas, we're going to build buffers. We'll have multiple imports we place from. There'll be a fiscal cost. There'll be a dollar cost. There'll be an opportunity cost. That's just the cost of avoiding shocks. It does not mean that we regress into autarky.
So, here, just to play devil's advocate, right, is the trouble is we have one very, very, very large and dominant player who is dominating virtually every supply chain. And we don't know what that choke point is until they hold it over our head, right? So no one thought rare earths and lithium were an important part of any supply chain until China made the crazy move, right? Only more recently, as solar has become larger and larger portion of our entire energy production, have we realized how important Chinese imports are in that particular space. Same with pharmaceuticals during COVID, right? So
Yes.
it's so one way of thinking about it is, are they on the opposite side of this trade off relative to you and me, because now they are worried that every single thing that is produced in China, and China produces pretty much everything, is just that much cheaper, and depending on what the geopolitics are, they can hold it over our head. So we need to build some resilience in every area, if not autarky. But the process of building resilience means some protective barriers, which means we get somewhere closer and closer to very high trade barriers, if not autarky. Like, is that how they're thinking about this?
I don't. I can't speak for them, but this is a slippery slope I worry about.
Yeah,
And
it's the slippery slope I worry about too.
if you go down a path, then how much of the supply chain do we want to replicate? So therefore, I began by saying that if you think about risk management at the macro level, first is on highly sensitive areas, fearing a global cutoff, you build buffers. China has built buffers on agricultural commodities. So some areas you can say very sensitive goods build buffers. Wherever you can, diversify. We are now buying more LPG from Australia.
Yeah.
We could have been doing that before the crisis. We're buying more LNG from the US. Third, and I'll get to China in a second. The third issue is hedge prices.
Yeah.
Mexico exports oil.
Yeah.
It does the famous hacienda hedge in financial markets. It pays 0.1 or 0.2% of GDP and buys put options to take over the price risk. India could have been doing that for the last decade. I've been
Yeah, but
pushing.
we don't like markets, so we don't do that.
And for the China stuff, you're right. China is a monopolist. There is no way to diversify that risk. Therefore, I said, if we can get more FDI from China,
FDI, especially in those areas,
the
encourage
hedge,
them more.
that becomes a hedge. So I think
Yeah.
it's a combination of building buffers, getting more FDI from China in the areas where they're a monopoly, hedging prices, and diversifying imports. I think if you do this, you can take care of most, if not all, eventualities. We don't need to be replicating the entire supply chain at home.
Yeah. So, the second part of trade liberalization, which again, like 15, 20 years ago was a big topic of discussion, even when people were pro-trade, was on labor elasticities. And you've written about this. You have a paper with Devashish Mitra and Praveen Krishna on Turkey. And then I think Devashish Mitra, Rana Hassan and Ramaswamy did one for India. And the message is either mixed or not good, right? So trade liberalization has definitely increased pressure on labor markets, especially in India at the subnational levels. These papers were written 15 years ago. The trouble is now the capital labor ratio is even worse. There is much more automation. So the pressure on labor is even higher. I mean, if I were to be a betting sort, I would bet it's worse news now. So that's no longer a hot button topic the way it used to be 15 years ago. But is that another big problem we need to worry about when you and I are still extremely pro-trade and liberalization, even in the current climate when we're trying to bring manufacturing up, but not just manufacturing, jobs growth in manufacturing?
Great question, Shruti. So, firstly, in our paper, we actually found a different result.
Yeah.
But of course, it was quite special that we found that trade liberalization in Turkey, there was a good national experiment there, did not increase labor demand elasticities despite liberalization. Now, that was unique to Turkey. It probably increases it in India's case.
Yeah.
But the broader issue is the following, that we must appreciate what trade does and what it doesn't do. Trade increases the size of the pie.
Yeah.
Right? And I think and that efficiency gain we've seen in the world in the last 30, 40 years.
Yeah.
That efficiencies have gone up, millions of people have been pulled in emerging markets out of poverty, created jobs. So the size of the pie goes up. There are clearly distributional consequences from trade. The US has seen this, the whole hollowing out of the Midwest, true in emerging markets. What you're getting at is when you do trade, the size of the pie goes up, but this is going to skew bargaining power of capital versus labor, make certain factors of production more vulnerable. And this is where public policy has to step in. This is where public policy has to step in to buffer the impact, to say we want a larger pie, and the distribution of that pie, public policy has to step in to offset or mitigate the
Yeah.
distribution of that pie. But this leads to a more broader question, Shruti, because I worried about how India's capital labor ratio has steepened so much.
Yeah.
This is even before AI and what's going to happen on services. We have a lot of global capability centers. Worry that if AI continues at this pace, what does it do to jobs over there? The broader question is, how do we make labor a more attractive factor of production?
Yeah.
And that's just another way of saying, capital is going to be becoming more productive forevermore,
Yeah.
right? That's inexorable.
Yeah.
How do you give labor a better chance to compete with capital?
Yeah. And
And
that's about skilling and education
that's
and
about
building
it.
the human
I know
capital,
it
health.
sounds really boring, but it's never been more urgent. It's never been more urgent. Education, skilling, health, mid-career training, all of that stuff, right? And welfare nets where labor gets left behind, right? So part of this issue of trade elasticities is, yes, there will be winners and losers. We know that from trade. The winners outsource the losers, but the losers tend to be concentrated, right? People may lose some jobs. The winners are more diffuse, consumers gain. And how does public policy compensate the losers? But I think that has never been more important now, quite apart from technology, right? And I mean, there's this debate in the US about what caused some of the job losses in the US. Was it really China joining WTO, or was it technological progress over time? So today it's
Yeah.
trade, tomorrow it's going to be technology. But the question is, what can we do to give labor a better chance to compete with capital? I think that's the fundamental challenge that we face at this moment in time. It's not an easy one.
So, before I let you go, one last question on where you think we are in India on sort of the Mendelian trilemma, right? So now the world is a little bit different because now this is a capital account issue, not so much a current account one. But maybe that's part of the bigger problem, right? So you have on the one side a question of inflows. You want to have a rupee managed, or rather, the rupee is managed by the RBI. It's not determined by the market, and we want to determine monetary policy and keep inflation low, which we've been remarkably successful at doing in the last decade. Now, you've kind of switched corners within that triangle. Like India has never been in any particular corner. We kind of manage all three in some way. But you've switched corners because now you're like, we need more FDI. So we need to think about capital inflows and we need to think about how we manage the rupee. So do you worry at all about what that does for independence in monetary policy and stability in monetary policy and how we managed it so far?
Great question. And I think actually that's one area where we've actually gained success. And let me explain to you why. So, firstly, I think there's no doubt that we need more capital flows into India. We need more FDI for technological transfer, to finance our current account, for higher investment rates. We can't abandon that, right? The pace of capital account liberalization, we can debate. The direction, we should not.
Yeah.
Now, the good news has been that, see, the Mundell trilemma, the trilemma presumes that you only have one instrument. But in the practical world of central banks, you actually have more than one instrument. And as the RBI has shown, that what's happened in the last few years, and I've been very encouraged by it, that we've actually used interest rates and liquidity
Yeah.
for domestic growth inflation dynamics, in that interest rates have been independent of where the Fed has been.
Yeah.
And we've managed the external sector by sterilized intervention, right? So I'm not sure that we're stuck in the trilemma, Shruti. And in fact, the best evidence of this is if you look at India's interest rate differential with the US.
Yeah.
Right? There used to be a time where we were, 300, 400 basis points higher than the US, right? And we could only cut when the Fed cut, or when the Fed hiked, India was forced to hike. That we've broken out of that syndrome a long time ago. I would argue for the last 6, 7 years, our interest rate differential has narrowed very sharply.
Yeah.
India's interest rates today are what, 150, 175 basis points above the Fed, right? And it's much lower than the fact that that interest rate differential is narrowed
Yeah.
is the best sign of monetary policy independence, because monetary policy has not become hostage to the Fed. So when the Fed does move, the exchange rate comes under pressure, but the RBI has got multiple instruments on that front to ensure that those exchange rate pressures do not mean a automatic hiking of interest rates, right? And so, to give you an example, like over the last year, from 25 onwards, we've cut much more aggressively
Yeah.
than it has, right? And yes, there was some exchange rate depreciation. So I think, let me put it simply, we've allowed in the last year and a half more exchange rate flexibility, which has meant that you've broken out of the trilemma. Then you've maintained capital flows and monetary policy independence. And even when there is a trade off, there is more than one instrument. If you use standardized intervention, central banks, within some degrees of margin, can do both. They can manage the exchange rate and they can keep monetary policy independent. That said, I think we should be very conscious that uh, exchange rate should be managed not only when there are large shocks like this, but on a more day to day, week to week, month to month basis, because then markets develop.
Yeah, you
See,
just smooth it out and markets will develop. Yeah.
because what happens is right now we're worried that, oh, everyone's going to start hedging. But when there's exchange rate stability, too much stability, it dissuades people from hedging. You want to be in a situation where people hedge in the normal course of events, and then there's no moral hazard on the exchange rate
Yeah.
to remain stable. So I don't think that's the most acute trilemma that we face. I think we found a way to manage that.
Yeah.
Yes, should be more exchange rate movement. Yes,
Yeah.
it unshackles us even more.
But are you at all worried that the kind of capital inflows you wish to attract, and I specifically mean you in this instance, is going to make the management of the other two a little bit harder, especially on the monetary policy side?
Not really, because so we want to get more FDI, right?
Yeah.
We want to get more FDI. So let's say we're successful in getting an FDI. What happens in that case is that the RBI will simply absorb that in terms of higher reserves,
Okay.
or even if it lets the exchange. So we shouldn't be puritanical about this.
Yeah.
The first task is going to be once this pressure point boils over and capital flows return. Let's hope that sooner. We will need to rebuild reserves.
Yeah.
Right. And you don't want the exchange rate to take the full adjustment.
Yeah.
But even in the case, let's say the exchange rate does appreciate, that's not where the pressure point is, because in that case, that's disinflationary.
Yeah.
So letting capital flows come in and letting the exchange rate do the work is disinflationary, which means it takes the pressure off the RBI. The problem happens in the other direction.
Other direction, yeah.
It's when capital flows out,
Yeah.
right, and the exchange rate is under pressure, that sometimes emerging markets want to raise interest rates to prevent that from happening. And that, in a way, is not in sync with your domestic growth inflation dynamics.
Yeah.
And monetary policy gets stuck defending the rupee. But the good news is we haven't seen that in India the last couple of years. In fact, the whole idea of inflation targeting was monetary policy should not be defending the rupee. It should focus on growth inflation dynamics and let the rupee be determined by external fundamentals.
Yeah. No, but on the other hand, if we start opening up our markets such that we get more capital inflows, then that also opens the door to have more capital outflows. So the downside that you were talking about, isn't that just a natural consequence? Like it'll be cyclical one day, right? So at some point, we'll end up having to manage this.
And the way to manage that is twofold. When you've got a large chunk of reserves, so you let the exchange rate be the first shock absorber.
Yeah.
When that exchange rate movement gets disruptive, right, then you intervene with reserves to slow the pace of depreciation.
Yeah.
So I think there's a well-oiled playbook for this.
Yeah, and we have the reserves for it also.
We have plenty of reserves. So when capital flows in, they tend to be very pro-cyclical. At some point, capital flows out. When capital flows out, so be it. Let the exchange rate depreciate like it is now. And if that depreciation gets too disruptive, then you use your foreign exchange reserves to slow that depreciation down.
Yeah.
But you don't use interest rates hike, right? And I think successive governors have ensured that doesn't happen. We've not raised interest rates to stop because of rupee depreciation. Interest rates will move when that rupee depreciation translates into higher core inflation and your inflation mandate gets threatened. Then you use interest rate as a second round.
Yeah. Is that coming our way, by the way, just because of the fuel prices shock that is approaching us? We thought this war will be over in 2 or 3 weeks, and now it's just gone on, and we're getting into June. So, is this where we're headed in some way?
We've spoken about all the challenges. Let's end on some positives here. Let
Yeah.
me give you three. Let me give you three positives.
Okay.
First, we were in the pandemic. We began the pandemic with an economy that was slowing sharply
Yeah.
on a weak wicket. In contrast, we've entered this episode with a cyclical upswing.
Yes.
Spoke about the six factors that drove growth, and growth was strong in
Yeah.
March, right? So we've got a good starting point on growth.
Yeah.
The other good starting point is on inflation.
Yeah.
That last year inflation was only at 2%,
Yes.
and core inflation is still running at 2.2%.
Yeah, but that's
Now,
because of good inventory management, right? When that ends, like any time in the next few weeks, are we looking at a serious oil shock?
so a couple of things. So I don't think so. Two parts. So one is the good news is not good news, but the inevitable outcome is oil prices have begun to move up. Retail prices of petrol and diesel have begun to move up. That's very important
Yeah.
because you want prices to reflect their opportunity cost, so you
Yes.
get the right behavioral response.
Yeah.
Right. So that will push up headline inflation.
Yeah.
Will push up core inflation, which is when central banks get concerned, is an open question. But I would argue, Shruti, one thing we haven't talked about is India is still 5% below its pre-pandemic potential path.
Yeah.
And that has meant there's still slack in the economy.
Yeah.
Also, Chinese imports have exerted lots of disinflationary forces. You marry both those things, and that tells you why, in the last 2 years, despite growth being resilient, India's core inflation has averaged only 2 to 3%.
Yeah.
Because there still is slack and there is the Chinese disinflationary impact. In that environment, you need to see very sharp and sustained input price increases
Yeah.
for second round effects to be elevated and sustained.
Yeah.
So I'm less worried about where inflation is headed. I'm more worried about the balance of payments.
Yeah.
So the good news is, growth was strong coming in. We can take a bit of a hit this year. Inflation was benign. So there's some ways to go before the RBI gets worried. And the third piece of good news, which may be temporary, is that we began by discussing shortages.
Yeah.
And the worry in March was that we will see widespread shortages by the month of May if the state doesn't open. There, the good news is that we've been able to source more crude and more LNG from around the world. Now, this
And
is a
we've diversified.
to diversify. LPG is still a problem, but at least for now, these are the three silver linings. Now, of course, if this continues for a while, all of this will come under question.
Yeah. And irrespective of what's going on with the, West Asian crisis or even the broader geopolitical trade stuff, we just need to get the house in order when it comes to reforms, right? I mean, we need to get our factor markets in order. We need to remove distortionary prices for all these inputs like fertilizer. So I think, a crisis is a good time to do it, but any time would be a good time to do that stuff.
So the problems are well known.
Yeah.
Right? Challenges are well known. The hope is that a crisis like this
Yeah.
opens up the political space to push on some of these. And we saw that last year.
Yeah.
You see, when 50% tariff came, I think it pushed us to do the GST stuff. That was being negotiated for a long while. But it focused the minds to do it quickly. We got something on labor reform. We began discussing the two deregulation committees. We began to think of import tariffs and QCOs coming down. So we got some of that momentum started. We should hope when the fire
just keep building on it.
yeah, when the firefighting from this episode is over, we use this to say, listen, the world is changing in undesirable ways. For India to compete and be attractive and get pull FDI and pull flows, we need to take out some of the hard decisions that we've been, faced with for many decades now.
Yeah. So hopefully you and I will be in business and have lots to talk about in terms of reforms. Thank you so much for doing this. This was such a pleasure.
Always a pleasure, Shruti. Thank you so much.